welcome to the first edition of the Balanced Perspective for 2024. As usual, I'm your host, Mansur Naka of Nedgroup Investments, and joining me, as always, is Iain Power, the CIO of Truffle Asset Management. Welcome, Iain.
Thanks, Mansur, and welcome to everyone joining us on the call.
Iain, another eventful year that we had last year. This year shaping up to be another year full of, I suppose, possible events and risks and things to look out for. Just to kick off, the market and the economy, particularly in the US, has continued to defy expectations as we saw in 2023. We know, relatively speaking, the market looks expensive there. And I think given the pace at which markets evolve and change, how has your thinking changed around this? Is it still more of the same? Give us your thoughts.
Yeah, thanks, Mansur. So I think in terms of what's sort of priced into assets in the US, there certainly does seem to be quite a lot of froth priced into those assets, where one has got, almost a best case scenario that's priced into equities in terms of a soft landing and, perhaps even no recession this year. So I think, when we look at many of these assets with multiples that are high, there's nothing wrong with having a high PE or high rating, but you've got to be able to grow and deliver the growth into that multiple. And I think that's going to be the test this year. But having said that, as you quite rightly pointed out, the US has been stronger than expected. And, perhaps because one of the big parts of the economy which, normally feels pain when interest rates go up, which is US consumers via their mortgage payments, many of those consumers have not felt that this cycle. So, the damage from higher interest rates is probably going to be felt in other sectors and in other transmission mechanisms and perhaps in the commercial property space this year. And, that might then cause an effect to sort of roll through, I guess, the economy. But the bottom line is that, the assets are priced pretty expensively. And certainly the tech stocks or the Magnificent 7 or 8, certainly look pretty expensive and are pricing in lots and lots of benefits from AI. So I think investors need to be careful, because if the businesses don't deliver, as we've seen, some did, some didn't, there can be some violent price reactions.
Definitely. As a multi-asset portfolio manager, you and the team have a lot of levers to pull on, to generate those superior long-term returns. How are you and the team thinking about the returns we can expect from the various asset classes? We can do global and local.
So I think the first point would be to make is that outside of the US, there's certainly lots of opportunities. And I think from a multi-asset perspective, one of the things that we are trying to focus on is build more robustness in terms of portfolio construction, because of the fact that this 60 to 65 odd % of world equity looks pretty expensive. And if something doesn't get delivered, chances are you could have some sort of derating or price correction, which would roll across all markets. So therein, the importance of building something that is robust, that is where the positions are as uncorrelated or as independent as possible, and where we've got deep margin of safety. So where is that margin of safety? So at the moment, we think, in global credits and some of the global fixed income, you can almost get equity-like returns for much, much lower risk than you would access through US equities. So the portion that we would have invested in US equities, a big chunk of that is sitting in global fixed income, which is earning, pretty attractive returns. And we think, sort of ticks the box from an investor point of view, getting a real return, but also at low risk and low probability of losing capital. So that's the first point. And then secondly, outside of the US, Europe, Japan, some of the emerging markets, many of these shares are trading at, like in SA, are trading at very, very cheap multiples. Depressed earnings bases, and there's lots of factors at play in many of these markets. But I think the big point perhaps to make is from an EM context is for those assets like our own market to do well, we need to really see the end of this global cycle, and for US rates to at least, start to fall, which will then catalyze, I guess, a shift of capital out of the US, out of the dollar, and to seek higher returning and risky assets. And EMs as well as SA would be a beneficiary of that. Outside of that, Japan, where we've had a position for quite some time, we add a little bit more to that in some areas, but really looks attractive in the DM space, where you've got valuations that are, pretty attractive, balance sheets that have lots of cash. In some cases, many of these businesses have, significant net cash on the balance sheet versus their market cap. And Japan is one of the only economies, G7 economies in the world, that has a positively sloped yield curve. They do not want deflation. They want inflation. So I think that's a positive, and a positive for many of those counters. So I think a portfolio of equities which is probably defensively positioned in the nature of the stocks that we have, with lots of margin of safety, focusing on yield, high free cash flow yield, and where we can see, robustness in at least the earnings and the valuations, to the extent that if we get some shock flowing through from the US, our investors won't permanently impair any capital.
Which brings me to my next point. I know as part of your process, you and the team spend a lot of time thinking about the risks in the market and to the portfolio, avoiding those traps, avoiding those bombs. What's top of mind for you right now?
Yeah, so I think, probably the big point would be around, and if we just start on a global perspective, some of the risks that I'm sure, you've touched on before, but we were 4 billion people voting this year, as you know, around the world, and I think the potential for tail outcomes, or the fat tails, is reasonably high, and that's intertwined with geopolitics. So, for example, we know in the event that a Donald Trump has to win the election, he would come out with some very aggressive anti-China policies, and the potential to destabilize geopolitics, supply chains, company profitability is enormous. And one can't even sort of, think about how it would roll through markets, but you just know there'd be more volatility, and markets don't like uncertainty, they like certainty. So I think there's lots of uncertainty. Then there's the wars that are going on, and I guess one needs to sort of think about that. And then there's the economic cycle, which, is old. Rates have gone up a lot. There's a couple of creaks and strains that we can see, but the thing that will probably break is the thing that no one will see, as it always is when you look in the rearview mirror, and, hence the need to have some sort of defensiveness in your portfolio. In other words, focused on the price that we've paid, and make sure that those assets are not expensive, and that the expected return in those assets, notwithstanding volatility, still means that over time, our clients can get those real returns.
Yeah, all about that sort of latent return that you're building into the portfolio.
That's it.
Coming to the portfolio, the Balanced Fund was quite defensively positioned last year. We spoke a lot about this. Some of it didn't work out. Some of it, I think, towards the back end of the year actually came through again.
Yeah.
Looking at the portfolio now, it's slightly less so, with overall equity exposure having increased. Are you optimistic about sort of the opportunities you're finding at this point?
So I think in the opportunity set, as I said, ex the US, I think there's a lot of opportunities, and we're getting closer to the point where I think that cycle's getting to its natural conclusion. But I suppose the big thing that we have done recently is we removed the collars around our NASPAS position, which has added about 3% of equity to the portfolio. So the physical exposure hasn't really changed, but we've sort of taken away that. And I think just because you would have seen, year to date and into the back end of last year, many of those Chinese shares have been badly beaten up, and have come down to very, very low levels. And I think the pressure is building on, the Chinese to add more stimulus. We've seen more rate cuts, and we suspect there's more to come. So I think, perhaps just thinking about the potentially an asymmetrical outcome for the likes of a Naspers and a Tencent, and reducing the need to insure around that. So I think that's added a little bit, 3% And then I think around our offshore or equity exposure, we've added, slightly to some of our European positions. But more or less, if we look at the sort of portfolio as a whole, it is still defensively positioned because of the names that we have. We are steering clear of tech, particularly US tech, and many of the companies that we have, we can see catalysts for them to grow. and to actually deliver the real returns, irrespective of, for example, a cycle from a global perspective. So I think it's still time to not put all your chips on the table, and I think we're going to see volatility this year, and I think we'll see some domestic volatility from an SA context, given the elections and what we've got to get through. But generally, these assets are not expensive, and in those EM markets, and in Japan, and in Brazil, for example, these assets are pricing in a fair amount of bad news.
I suppose also, given the sort of cash flow yields that you're finding on the current positions, we're also being sort of paid to wait, before actually taking, much more risk.
I think so. And I think if we look at just the dividend yield on sort of, I guess, the SA, MSCI SA, or some of the SA Inc. names, dividend yields this time around are pretty high because the market is derated, as you know, for all the reasons that we know, which means that the entry dividend yield for many of these shares is between, let's say, 7 and 10, and the earnings base is at trough levels. So if you go back to sort of investments 101, what are you looking to do? You're looking to buy into a security which is trading at a cheaper valuation. We can tick that box. We're certainly well below 1 standard deviation. So some cases 2 standard deviations cheap, and earnings bases are low. So companies are under earning. How do we know that? Because last year we had load shedding. And that load shedding, as we've seen with some of the corporate results start to flow, is rolling out through the base. So you're going to get higher earnings with low ratings, and at some point in the future, when that is, we don't know, but the global cycle will roll and we'll start to get into the rate cutting cycle. And I think that really brings better prospects for some of these emerging market and other assets other than the US.
Iain, as always, lots of food for thought on that point. We'll leave it there. We'll end it. Until next time, we'll chat again. Thank you and goodbye.
Thanks, Mansour.